Welcome everyone to our weekly live session as usual. The date is Saturday, March 19th, and we just came off a pretty great week, quite a bounce following FOMC. As I mentioned last week in the live session, I recommend if you didn't watch that to go take a look because I did mention in there my long-term sort of projections of why I think that there is some cause for concern, mainly regarding the escalation of war in Ukraine and some of the risks that come with that, as well as the real implications that arise as a result of that being economically. So some of the commodity prices, oil prices, all of that, and sort of how that is exacerbating inflation. So I recommend actually listening to that if you didn't haven't so far because just you could put it on 2x speed and in YouTube they automate a transcript as well, so you can kind of read along with it. So it makes it much more quicker, and then you can kind of look at the timing where I begin speaking in the beginning, and DJ comes on, and then he passes it back to me. So you can look at that. But yeah, just as I predicted just last week, last Saturday, I was mentioning that short term extremely bullish, and I was targeting 440 to 450. We got actually right on there, so right in the middle, 445. So quite a bounce, which I was expecting. And I mentioned that at around this range I'd be looking actually to go short. I could my ranges could be um a sort of low, so possibly we extend a little bit further upwards into more bullish territory. But as I mentioned last week, my rationale is that around these prices are where you know investors, I think, are sort of contemplating a little bit of you know eh, do I take the loss here and avoid some of the unnecessary risk factors that are evident currently in the macro economy and macro market. And I think it's also an inflection point of where some of the starch bears turn possibly bullish, and they kind of enter a sort of bull trap. But the thing, as I mentioned last week as well, the thing about bearishness, or some of the bearish effects that enter the economy and hit consumers, is that sometimes the bearishness takes a little while to actually factor into the market, and so it can be sort of prolonged, right? So I think overall, I think, as I mentioned last week as well, that the sort of risk factor, I think overall, you can sort of position your portfolio where it depends on your how your portfolio is structured, but possibly your long end of your portfolio, you can keep as is, and sort of just average down as at where we were and where we are, etc. But your more active end of your portfolio, I would sort of begin liquidating. But as well, there is a possibility that we sort of shoot and moon and quote unquote melt up, and there is that possibility. Personally, I just think it's unlikely for the reasons I mentioned last week. And yeah, that's just my opinion. I could be wrong, and as I mentioned to a couple of members who are asking, if you are positioned for that, and we do sort of just completely recover and go forward, I mean, the payout would be great, but I just think that this is sort of the bounce I was looking for, and this is really exactly what I expected, as I mentioned last week. So um, I would be utilizing this to sort of exit a lot of things. You can sort of leave your long portfolio allocated long even during this time, and it sort of hedges you and balances you out. Or even you can sort of um, sell a portion of your holdings, and it sort of hedges you out, where if we were to drop another x percentage, you're now sort of hedged because you saved that loss. And if we were to gain that x percentage, again, you're sort of hedged, so accordingly. You can utilize that. It depends on your portfolio. For me, again, I'm sort of I've become fairly bearish. I think that the recession is sort of imminent, and its effects are sort of taking a hold on the economy. And the war in Russia Ukraine, I think poses a lot of risks, and I don't think it's as sort of black and white as people think, where it just a negotiation is reached and it sort of ends. Unfortunately, I think that this might be fairly prolonged, right? And Putin is really unpredictable. So again, as I mentioned last week, you can't really rule out any of these war with the US, or nuclear options, and all of that. It's really unpredictable, and I mentioned all the reasons in the live session last week that you can sort of look at. But essentially, he doesn't have much leverage at this point. He's been really ruined economically. Him being Russia has been ruined economically. So now they're looking at, they don't have much leverage on their end. So yeah, that's sort of my thoughts there. And yeah, but going into earnings, we do have a few earnings this week. The main ones being Nike on the consumer products section on Monday after hours. We also do have CCL reporting Tuesday pre-market, Adobe reporting Tuesday after hours, Poshmark, along with Poshmark, Paysign, and then we do have EVgo reporting Wednesday pre-market, Jinko Solar as well, and then we have another big one, Neo, reporting Thursday after hours. So a few earnings this week. Oh, we do also have PDD as well, Chinese company. I shorted some out of the money calls there. So we'll see how that does. That should be reporting Monday pre-market. So look at that. But yeah, that's my sort of overall thoughts. It's played out as I expected. I was targeting this bounce, 440 to 450. We got right in the mid range there, and you can kind of notice sentiment sort of shifting a little bit bullish overall in the market. Where again, I think this is an inflection point where investors think, what, maybe it's over, maybe we're entering that phase. But again, I don't really think so. I'm thinking a little bit more longer term, and I'm thinking that the economic implications again are pretty uh, possibly severe, right? And then also I feel that if we were to you kind of have to look at it as the likelihood of going to new all-time highs, with sort of all this going on, and its economic implication. And I think it's pretty easy to say that it's fairly unlikely, but I guess we'll see. And then also, I think that during this time, with the risks present and the risk evident, um, even if you were to go to all-time high, I feel like most investors wouldn't really be missing much, right? Because it's like you go to new all-time highs, and I mean, you sort of just buy back higher, right? But you really you dodge the risks, all the risks, and I listed the multitude of risks that are evident currently, compared to during a regular sort of rational uh, business as usual market that we usually have. And again, the risk reward isn't really there, right? So yeah, that's sort of my thoughts on that. And then you also think of, institutions. How are institutions looking at it? And I mean, I don't know about you, but I think that, institutions, MS or wherever, whatever institution, I don't think they're really poised to aggressively invest in a market where there's so many risks as well, right? So yeah, that's my thoughts on that. I opened a little bit of a starter position in SPY MAPE puts, but the put pricing isn't that great, but it's just a kind of a starter. See where we go. I think if we sort of head a little bit back down, the puts have gotten pretty crushed through the past 3 days. So the pricing of them. So I thought just a starter. And I mentioned, I'll kind of reevaluate based on next week's move, and maybe either hold them or cut them, or yeah, if we pull back, take profit. But just watching. But I mentioned, as I mentioned, this was my targeting bounce, as I mentioned last Saturday. So we did get that massive move up, and I mentioned I was massively bullish, and now I think we're at that sort of inflection point. So I'm going to be watching this week, and see how we move going forward, and sort of update you guys. Um, so yeah, but yeah, I'll expand on that a little bit further, but that's pretty much it. But I'll pass it on to DJ to share his thoughts and go over his usual spy analysis.
Yeah, so we got a very big bounce this week, 30-point bounce, which I alluded to was quite possible and likely, and the target of 445 was the high end of my range post FOMC meeting. I did think shorts would get squeezed heading into the meeting, and that's pretty much what happened. Um, on a macro level, my thoughts are fundamentally the fundamentally the economy is basically screwed, and there's no real really saving grace. You can only really prolong recession, but recession is inevitable in my opinion. Um, However, technically speaking, um, really it looks like the bottom is in my opinion. Technically speaking, across multiple sectors, multiple stocks, indices as a whole, it is a break above the downtrend, a break above multiple key levels for just major indices and stocks in general. And if I have to say what I think will happen, um, it looks like to me that I actually think we're on a decent path to, I wouldn't say melt up, but I think we're in a decent path to get to around this 470 level on SPY, and possibly retest all-time highs in the coming month or two, I think. Just based on technicals and also based on still sentiment, which I actually think we're still quite bearish on sentiment right now. And I think there's a lot of people in disbelief in the current 3-4 day rally rather than people switching bullish per se. I think there's a lot of people who don't really believe in this rally, so they are not really, buying back in. They're rather waiting slash looking to enter puts on this range. So that sentiment wise, I still think is way more bearish than bullish. Shorts have gotten squeezed pretty hard 4 days. So I mean, we can obviously pull back a good amount, and especially all the charts, the hourly RSI, I think it's above 70 for a majority of stocks and indices. So we're definitely overbought in the short term, in the very short term time frame. But I mean, if we're looking at the daily chart or the weekly chart or the monthly charts that we'll kind of take a look at later, there's really nothing overbought, and everything is still, you could argue, oversold from levels. So Um, that's my opinion macro-wise. I mean, what I did is I don't really have a real long-term portfolio because I pretty much, if anything, I swing some stuff for a couple months and then I take profits or losses and kind of my long-term portfolio is just a slightly longer, slightly less active kind of trading portfolio on my end. But I think if you're in any of the high growth tech stocks, I mean, we saw a massive move this week. I did say to went and learned to buy like Square, for example, I think around 115 levels, and I mean Square is at 140. It bounced about 50% in 4 days, so I mean it's a pretty good level to be, trimming out, taking profits, regardless of whether we're going up or down in the future. At current levels, I think um, downside versus upside is relatively even actually, because we're not free falling anymore on the markets. So it's not like we're in this oversold free falling stage where you don't know where the bottom is and you don't really have a level to cut because a bounce is imminent. But because we found the temporary bottom and we had a massive bounce, now there's a lot of support levels. So I mean, I would say on SPY, for example, I mean, if we're dropping 415, then it's pretty much screwed and we're heading to at least, sub 400, 380 levels. That's around, 30 points away on SPY. It's around 415. You could say 420 or 425 is similar, so that gives you about a, 20 point stop. But I think the upside also at this point is around 470 before we get a pull and a possible retest of all-time highs. So I think roughly it's at a pretty okay midpoint, I would say, between risk risk reward. But would I be entering new positions? Definitely not right now. It's a 4-day green rally, and I mean it's massive moves in the 4 days. So I mean definitely options IV have been spiking. Even have VIX has been going back down. So I mean if you're all cash, I think I would actually be looking for a pullback to position myself a little bit long term. If you're not all cash and you're heavily invested, then I would actually be trimming because I think the ideal scenario right now is you want to have a good chunk of cash, let's say like 60 to 70% cash. I think it's a good ballpark range depending on your portfolio, and then I think the rest, I would still position myself actively and look for longer term stuff like September, December. Um, I did alert some new stuff this week, throughout the week actually, but I think I took a brand new position in IWM for December leaps. I think those are actually priced pretty good, and the risk reward is actually pretty good on those leaps. So I think that's not a bad level to be taking it. And I'm not sure if the worst is over by any means, but I think just because we have broken out now, I, I think I can just let the market play itself out. Like I don't really see much need to try to predict and forecast what happens. I'll just kind of let the charts speak for themselves, and as long as the charts are putting higher lows and not breaking lower, then I'll assume that this is a possible reversal to the uptrend. And obviously, if we drop another 5% from here and retest the lows and break it, then the charts speak for themselves, and we're going back down. And I would just cut the remaining portions of what I have active. But the majority of my stuff is trimmed for the most part, so it's not really a big deal. But if we are to continue to kind of hold the lows and build back an uptrend, then I mean we're just heading back to retest all-time highs or even more. Then I'll just kind of let the markets reevaluate itself from there. So I'm going to ignore the fundamental side of things for now because, in my opinion, it's a little bit too hard to judge whether or not recession is priced in, whether or not uh, I wouldn't say priced in, obviously, but what I mean is that if recession is partially priced in, and by what percentage is priced in, and then there's a lot of questions that I think would be kind of impossible to answer. So kind of just let the markets move itself. And I mean, if we're heading back to all-time highs, the market will tell you that everybody was wrong, and although recession is imminent, um, it clearly does affect the market. And if we go down, then vice versa. So the main thing this week is FOMC passed. Summarize, Powell basically raised the interest rate to 0.25. As expected, quarter point hike, projected 6 more hikes this year, and I think 6 hikes in 2023. That's very, very hawkish, pretty much as hawkish as you can go. The reason I believe Powell decided to project 7 hikes this year is because the market has priced in 7 hikes this year. So I think from the Fed perspective, if the market is pricing in 7 hikes this year, even if you personally only plan on doing 3 or 4 hikes, you only get benefit by going along with the 7, because by going along with the 7, you know that the market priced it in, so you're not going to be damaging the market regardless. You're meeting expectations. And then by going 7, if you then want to retract and go to 3 or 4 or 5, then it's actually beneficial. So I think that's the reason they projected 7. I actually don't think the Fed will do nearly close to 7. But I understand the reasoning, and I think the reasoning is a smart move. And I also think the 7 projection um, is very bullish because of how the market reacted. I mean, we rallied what 6-7% in 3 days on the S&P, almost 10% on Nasdaq, QQQ, and that's with 7 rate hike projections. Um, and 6 more to come the following year. So I mean, that's actually all bullish. The fact that in extreme hawkish projection, you know, reverses bounce. So I mean, if I were to argue, do I think the Fed will raise 7 times this year or not? I would say like 95% chance it's under 7, because I mean 7 is the maximum they can literally do. So and because of that, there is a very real chance that um, we might see another hike in the following 2 months or so, but there's a real chance they could definitely slow down or delay a bit. And if they slow down, delay it, then the market perceives that as bullish, and it's definitely fuel to continue and move up from there. Another thing I wanted to note this week, um, there was a lot of talk about potential peace and whatnot the following weekend before, but this week Putin pretty much came out and said Ukraine is not serious about negotiations. I mean, pretty much the translation is Ukraine is not listening to our demands, because there's not really a negotiation. It's pretty much like Russia puts their terms, and if Ukraine doesn't accept those terms, then they're not getting anywhere. So I mean, there's no real negotiation because Ukraine doesn't really have the position to be negotiating. They're not in the driver's seat of this situation for sure. So he pretty much outright denied any progress in peace this week, and the markets kind of absorbed that pretty quickly, in my opinion. And I mean, we 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 pretty much bounced like 30 points with like denial of peace and a very hawkish Fed in the FOMC. So, and this is a trend change. All these things are very bad kind of outcome of catalysts, in my opinion. But the price action was extremely bullish this week. So that is something I think going forward definitely makes me biased towards the bullish side and bearish side. The only thing is we're overbought in a very short term, but I think um, key levels. Well, you can see kind of this line I drew. This is pretty much the downtrend channel that we broke out. So it's the same for every single chart I'm going to show, but pretty much I think the key is just follow the kind of the daily EMA and middle Bollinger Band. We've been trading below these lines for pretty much like 3 months, 2 or 3 months. We're really downtrending this entire time. And the last time we had 4 green days was basically back in January, and this bounce was heading into the FOMC. And I actually think we would have continued to retest all-time highs from here, but the reason we dropped back here and started falling to lower lows is because of Russia-Ukraine rumors and the actual invasion starting around early February here. So we are basically kind of back to that same setup before. We had that 4 green days pre-Russia-Ukraine, and this time Russia-Ukraine, or a lot of it has been priced in already. So what I'd say is we retook the daily EMA's middle Bollinger Band for the first time in multiple months. It looks like it is starting to kind of slope upwards, which means as long as we kind of hold these levels, naturally we could see a possible reversal of trend where we have an upper trend line and SPY kind of starts to grind up. I mean, do I expect very quick moves? Definitely not. Like 30-point moves in 4 days, that's huge, really. Like 30 points is something that usually happens in the span of months, not days. So this is just a very big oversold rally. But even if we were to retake the uptrend or such, it would be relatively slower, like maybe another 30 points in the span of the next month or so, month or month and a half. But I'm not expecting anything very quickly. Although, if we do continue up another day or another day, we'll be possibly looking to retest all-time highs in the span of next week. So I mean, anything short term definitely be trimming out along the way up. But right now I'm looking for some sort of stabilization and a pullback, and then I want to see if we can hold the daily EMA and middle Bollinger Band on the pullback to see if there is possible longer term bullish entries. So that's a daily chart on SPY. We broke out of this previous 441 range. So this is a a low, a lower high, a higher low, lower high, and pretty much a higher low, and then a higher high. So this is a break of trend for the first time in months. So that's something I would say. You can kind of ignore this line for this weekly chart, but this is also the first week on the S&P where we close above the weekly EMA since basically early January, back when we were all-time highs on SPY. Ever since we were all-time highs on SPY in January, we pretty much closed below the weekly EMA for the next 8 weeks or so, and this is the first week we closed above it. So again, I'd be leaning bullish until price action proves me wrong otherwise. It's the first time something has happened in uh, quite a long time. A couple months is a pretty long time. So if it wants to break lower, then just let price action show you it will break lower, and and if it holds support and trends up, then it will naturally kind of recover on its own. Dow Jones, actually, the reason I'm covering it because it's pretty much value boomer stocks, but Dow Jones is much better than SPY and QQQ because I mean it's the same 4 days, but we're trading above the daily upper Bollinger on the Dow, whereas obviously the S&P is below it and QQQ is below it as well. So I mean this is pretty much showing that value is still leading tech, although tech has been catching up in the past 3 days because for reasons I'll kind of cover next. But pretty much Dow is leading, and it is quite bullish, and so it does look like to me money is flowing back, not only in tech or not only in value is flowing back in pretty much all areas for now. And then QQQ 4 days green. This is what I mean. QQQ has caught up a lot more than SPY and the Dow this week. it's made a $32 move from the bottom, whereas the S&P made a $30 move. But QQQ is obviously like in the 300s and S&P in the 400s. So percentage-wise, QQQ definitely outperformed this week. For reasons I think it's relatively obvious, just because pre-FOMC tech stocks got hit harder than value because growth stocks get hit more with interest hike, and I believe that interest hike was overly priced in to the downside. So post FOMC, even though you see maximum kind of projection of hikes or so, tech stocks get the relief rally and much more than value stocks because they were the ones pretty much held down heading into it. So we see the reverse now, and we see tech leading value in the very short term. I think if we were to look at a retest all-time highs or future all-time highs, um, tech would definitely need to be in an uptrend by for sure because it's a major component of the sectors. However, I still think S&P and value will outperform just because it's still rising rate environment, and the reopening play benefits a lot of value stocks a lot more than tech. I think this kind of thing is only short term, where tech is outperforming just because of it got overly beat up to the Fed meeting. But overall, if we're looking a couple months out, and we're assuming we're starting an uptrend and such, I still think value is the way to go over tech overall. IWM, small caps. This is why I'm pretty bullish. I mean, this is also a higher low on IWM and a higher high above 205 levels. It's also right at the daily upper Bollinger level, and we're pretty much 1% away from testing levels on IWM we didn't see since January. Was very bullish. Small caps, as I said, multiple weeks are the main reason why the S&P and QQQ pulled back, because just so many high growth small caps have gotten crushed, and the fact that it's rebounding very strong, and it looks like to me it really wants to break a multiple month kind of downtrend and officially start an uptrend. So I think I'm pretty bullish overall just because of this factor. I think IWM could honestly see a move to the 215, 216 levels next week, and then potentially, in the span of the next 4 to 6 weeks, see a move to 230s, near the all-time highs, I would say. So, for that reason, I think leaps are pretty cheap. I think September calls are fine, but I went with December as well, just because I actually looked at the premiums on both, and you're not paying too much for an extra 3 months, so I figured I might as well just go and add some December leaps as well. And I think if we see a move to 230s, 235s in the span of a couple months, I think those leaps will triple or so. Baseline estimations, monthly chart, IWM, pretty strong. Which reminds me, take a look at monthly chart on S&P as well. So I mean, the month is obviously not over, and if you remove what happened last week, this would look nothing like it looks right now. But depending how we finish off the month in the next 2 weeks, we could potentially see a green candle, something like this, where if SPY closes, let's say around 450 by the end of the month, I mean, it's basically a higher low into an inverted bullish hammer close, which is quite bullish on a monthly overall. IWM, we double bottomed in January and February, and if we put in a higher low in March, and it looks like, more looking like we want to go green. So I mean, looking at the monthly charts, it looks fine for me for all major indices because price action we are getting higher lows for the most part. So I think that's fine. XLI, one of my core positions. June, I think is getting a little bit tight actually, because it's already been March and they're still about 10% out of the money. But I do think we'll see quite a strong move in the coming month, and then Um, I'll be moving my position into September 115 calls on XLI. I mean, I already have them, but I'm probably going to look to sell more June on the way up and just add to September's because I think it's really valuable to have more time on on XLI here. So that's my plan going forward. Very similar to IWM. It's been 2 months since it's been over 103 and it's been resisted multiple times, but it's looking like it's going to break out from here and look to go back to around the 107 range to retest all-time highs on XLI. It's been outperforming S&P this week. Very strong weekly candle, up about 5% or so. It's mainly getting benefits from infrastructure bill and just potentially reopening and supply chains fixing. So good place to be. Square broke out of the downtrend as well, and this is a very strong, like 50% move in 4 days. Uh, but it broke out of the trend where put in a low, put in a high, put in a higher low, and then put in a higher high. So this is a trend change for the first time since all-time highs on Square, and we are above the daily daily upper Bollinger Band for also like the first time in like 3 months since all-time highs. So um, I wouldn't fight the trend. And weekly, close above weekly MA first time. I think if you're in Square still, I think we could see a possible move to 160 to 180 range in the coming weeks. That's where I would definitely just sell pretty much the entire position because it wouldn't be worth the risk reward at that level. But I think right here, the downside is around $20 and the upside is around 25 $30. So it's roughly doable either way. Monthly chart, higher low, and it's looking like we're getting a bounce. So I think that should do fine. PayPal, very similar to Square, a little bit weaker, but also 4 days and also trend change and above daily. Yeah, May weekly here, still oversold. I'm eyeing a move on PayPal. I think you could see a move to 140, something like 135 to 145 levels in the coming weeks. And if we get a bounce like that, I'll be out the majority of my June calls there as well. And I just want to go through pretty quickly the FANG charts, large cap tech. I ranked them in order of strength. Amazon's the strongest, 4 green days, and it's actually touched the daily upper Bollinger on Amazon, which the last time price touched that was all-time highs back in November. So we haven't touched that in pretty much 3 months as well. Um, the reason I think is pretty obvious. They announced the stock split, and it's coming in the next less than 3 months. So stock split plus share buyback. It's the leading large cap right now, chart wise, technically wise. Facebook, even though it's oversold and stuff, is also touching the daily upper Bollinger Band and looking to starting to reverse the trend. Google actually looks very similar to Microsoft, which we'll see later, but it's pretty much near the daily upper band, but not relatively there. But still also held the daily MA and middle Bollinger Band, which hasn't happened for quite a while as well. We've been trading below these lines for a couple months as well. And then Microsoft, very similar to Google, same thing, but also holding daily MAs. Apple the weakest right now. Quite far from the daily upper Bollinger Band, and barely got over it on Friday. Reason for that is because they China had a lockdown for COVID last week. They reopened now, but because of that, Apple supply chain got hit a bit. So I think they tanked a couple percent extra, which is why the chart's the weakest for now. But overall, I mean, all of the large cap tech I see are trading over daily EMA levels for the first time in multiple months. So I wouldn't keep going bearish other than for a short-term trade at the moment. Because I mean, if we're looking at the hourly chart, yeah, Amazon's hourly RSI is at like 80, 82 already. So it's super overextended. I mean, this is the highest RSI level on the hourly on Amazon in multiple months as well. So I mean, it's very likely we will get some sort of pullback as soon as Monday. I think it's very likely we will get a pullback on Monday just because RSIs are well above 70s for, yeah, for the majority of tech stocks and for the majority of things. So I mean, it's to be expected that we will get a pullback just in the short term because of how overbought we are. But at the same time, um, other than for that short-term kind of trade, I don't know about swinging, longer-term puts for now, just because the trend reversed for the first time in a long time. So I think you rather just wait to play it out. Um, that's pretty much what I'm doing on my end. Um, so yeah, I'm gonna pass it over for the Ramji now, but I'm just gonna be watching the markets pretty much to see what they do next week.
Previously in the beginning of the live session, we were targeting the 450 to 450, 440 to 450. We've got right in the mid range of that target as expected. So yeah, that's where we are on SPY. I'm looking more at sort of the more macro market, which I mentioned previously, which is why I'm sort of leaning bearish. Overall and in overall risk and reward. But yeah, just kind of recap that and a couple of plays. Looking at oil, we really nailed it here. Pretty much got the whole entire move with the accelerated oil ETF SCO. We since recovered on oil, so we did get that whole move and exited at the top short oil. Oil's been coming back up, so this is the inverse ETF, which moves opposite to oil. So that's why you've seen that pullback, but we've already exited that. I was looking to kind of go long oil. We're back sort of above that that range. So just kind of watching it overall. I wouldn't go short. I looking to go long, but just waiting for the right entry there. And then moving into sort of equities. I'm sort of to kind of cover. I think that the I mentioned it in the chat, but I think the best if you were to kind of hold equities during this time, I think the best plays are three. So Tesla, Google, Amazon, and Google, Amazon mainly because of the fact that especially Google, it's more of a value company, a lot of cash, and with these two and the splits coming, I think it's a good opportunity there. Again, I think it'll continue to move with sort of the macro market overall with these two, as we've seen over the past few weeks. Although, again, if you're in equities, I think that the if you're invested, the best plays would be these three, which is sort of on a risk reward standpoint the most solid three plays in my opinion overall going forward if you sort of want to be invested. So in my long account, I'm pretty much holding these three and just less allocated, but continue to hold these three. And I think if anything, if we were to sort of recover, these three would be the best risk reward plays that would benefit the most largely overall. And then I also opened TLT this week because of the fact that if we I don't think that we'll go for that seven rate hikes throughout the year. So TLT will discount that, and we'll see I think quite a move up. Um, Sort of discounting that we won't get those seven rates, and if we were to enter a recession, as I'm sort of predicting, in the near term, we'll see a big move on TLT, which is bonds. So I entered that. The pricing is pretty good, and it's sort of just a longer play for January 2023, which I entered, which the premiums are good there. So yeah, but yeah, just kind of a recap, of my thoughts. I'm mainly looking at, sort of macros, because that's sort of what's controlling the market now. I think, uh, s- the main things sort of controlling the market right now are just solely, the war, where we progress with that, and then some, sort of interest rates and sentiment as a whole. So that's really what I think, people should focus on currently, because that's really what's having a cause and effect on the market solely. um those three things and those three factors, and that's sort of what I'm just focused on. So again, moving forward, the live session's recorded, so I would just go through my thoughts, and then last week as well, which I kind of lay out the bearish thesis, which I'm thinking, just because of the fact that the economic effects of the war in Ukraine, and what's resulting as a result of that, as well as a result of some U.S. government decisions. It's kind of exacerbating inflation, and again, it puts the Fed in more of a tighter situation, where they're kind of sort of stuck right now, because they don't have much leverage on their end, because again, you sort of have to strike a balance between raising rates and keeping rates low during this time, and with supply chain issues, and not really getting fixed at this point, and inflation only really accelerating at this point. The Fed really has their hands stuck right now, and again, the wrong move, too aggressive, too weak, both really continues to drive inflation higher, and the rates are really hurting the lowest class, which is lower income individuals, so in America. So and then obviously that has global effects as well, because it is the US, the world superpower, right? So yeah, again, I think that the Fed is sort of stuck at this point, and the risks are really accelerating. So yeah, that's my thoughts on that. And then going into earnings this week, just watching day by day, and sort of making decisions. But earnings this week, we're kind of easing out of earnings season, but there's a few earnings. Nike, which is a big one. Almost always bullish on Nike, going into earnings. So I think this one will likely be the same. So I'll keep an eye on that. Nike is a good play. Adobe as well, another one. CCL in the travel sector, reporting Tuesday pre-market. We'll be watching that, as well as Trip.com. And then Neo is a big one to watch as well in the Chinese space. Neo's gotten quite hit. Not a bad company, in the EV space, since recovered this week quite a bit, because it's a much cheaper stock. So we're sitting back at around $20 levels, but quite the sell off, because we were previously at $40 levels. We were kind of basing around then on Neo. Um, I mentioned before, a few people asked me whether to buy Neo. I mentioned it was, quite overpriced. We've since gone down to $20. Looks a little better here, but still, still a bit of a risky play. Neo's pretty good in China, really dominating in China, but yeah, I mean, there are those same sort of geopolitical risks that come with these Chinese stocks as well. But I think Neo might be a good play for earnings, so I'll be watching that and looking at premiums. It is also the end of the week, so I think it'll be a good lotto play, because it's reporting Thursday after hours, so we go into Friday expiry. So I'll look at that. If the premiums are sort of overpriced, I think a good on the shorting the premiums are pretty good market maker, or going long if the premiums aren't that well priced. Um, Probably the former, because I think that the data will get quite hit going into Friday. So yeah, we'll be watching that. But yeah, those are sort of my thoughts overall. I mentioned in the beginning, kind of laid out again my overall thoughts. But just to briefly recap, I think we're just at a sort of inflection point. It's the same thoughts I mentioned last week, as I predicted the move this week, where we massively bullish move, and we enter that 440, 450, which is almost halfway to all-time highs from the lows. And that's, I guess, sort of an inflection point in my opinion, and a point where you have some of the market kind of shifting bullish, and a lot of the market sort of looking at it and thinking that the with the risk imminent, they're sort of cutting losses, and on the institution side as well. I think it's even more imminent that institutions sort of de-risk at these levels. And yeah, so I started sort of a starter spy put position, and I'm in longer TLT. So just a starter. Going to watch, sort of the move this week, and reevaluate if anything. But yeah, just kind of watching the market to see where we go from here. But yeah, this was a great weekend, and the move that I kind of expected through this week through FOMC as well. So yeah, that's about it on my end. So I'll wrap it up here. But I hope everyone has a great remainder of the weekend, and we'll be back on Monday to go get this money, guys. So take care, and have a great weekend, everyone.
Yeah, take care, everyone.